Flexi has been quite active over the past few months buying put options to manage price risk for our clients holding hectare contracts this season. And the purpose of this clip is to demonstrate and explain why put options are Flexi preferred futures management strategy in the pre-harvest grain marketing window. Now, wheat pricing has three components, being futures, basis and currency. And movements in the futures market typically have the biggest impact on local grain prices. Now, strategies available to growers to manage the futures component of their pricing include hedging, where growers are selling a wheat futures contract, taking out a bank swap, which combines both the wheat futures contract and an exchange rate, buying put or call options, or physically forward selling grain. Compared with hedging and bank swaps and forward selling, put options are low risk. They have a known fixed cost, and importantly, they enable growers to participate in any upward movement in futures markets. Hedging, bank swaps and physical sales contracts expose growers to considerable risk should they have little or no grain to close out their positions. Growers can purchase put options in many futures markets around the world. Because of its size, Flexi prefers to trade in the Chicago Board of Trade futures market. It's the largest wheat futures market in the world, trading on both US and global demand and supply factors. Now, within any given year, there may be volatility within a futures market, and this volatility does present opportunities to growers to protect from downward movement in futures prices. Now, to demonstrate this volatility, I'd like to share with you the Chicago Board of Trade and how it's travelled over the last 5 years. So we have the Chicago Board of Trade wheat futures market and how it's travelled since March 2016 through to today. And you can see some quite pronounced peaks which I have marked, and these have been great opportunities for growers to put in place strategies to protect their pricing from the subsequent downward movement in the futures prices. Now, the holder of a put option has the right but not the obligation to sell a futures contract at a predetermined price within a predetermined period of time. By buying a put option, growers are protecting a futures price from any downward movement in that price. And you can see these peaks are distinct opportunities for growers to put in place put options. The Chicago Board of Trade trades in US cents per bushel. So there is a little complexity when we use the Chicago Board of Trade put options, because we need to convert from US cents of bushels to Australian dollars per tonne. So for the sake of simplicity, I'm now going to make an example or refer to an example using the ASX wheat futures contract. So I'll flick over to that now and share with you the ASX's Eastern Australian wheat futures contract. And this is this year. So what we've got here is basically the current season. So this is late March, early April. And I'm sure many growers will be aware the ASX wheat futures contract was trading as high as $360 a tonne. So if growers wanted to protect themselves with these prices from any downward movement in that futures price, they had a few options. So one was they could have forward sold grain at fairly attractive pricing. They could have hedged, so they could have sold an ASX wheat futures contract, or they could have taken out a bank swap at these attractive levels. But as many growers would know, this is late March, early April. Crops hadn't even been sown at this point in time, and many parts of Australia had fairly low levels of subsoil moisture, so production risk was high. So by taking out any of those strategies, potentially, if the season went pear-shaped, growers could suffer significant losses. A low-risk strategy that growers could have taken on board was to buy a put on this contract at this price. So let's do a hypothetical example of what would happen if the grower had done that. So here we are. Let's assume the grower had purchased a put with a strike price of $350 a tonne, and it cost the grower, let's assume, $30 a tonne to buy that. So the grower has purchased that put in late March, early April. And as you can see, the market has fallen away since. So let's assume the grower decided to sell the put option when the market was down here trading at $273 a tonne. So what's the value of that put option? Well, the value of the put option is effectively the difference between the strike price, being $350 a tonne, versus the current market price when the grower elected to sell the put option. In this case, it's $273 a tonne. So that put option had a value of $77, being the difference between $350 and $273. But let's not forget, it did cost the grower $30 to buy that put. So the net profit after that cost effectively is $47 a tonne. So if we assume the prices were fairly soft at harvest time And let's assume hypothetically the grower ended up cashing his wheat in for $240 a tonne. The grower would finish that season with a combined or final price of $240 from the physical sale plus another $47 profit from the put option. So final result for the grower being $287 a tonne. So that's a really good example where put has worked to protect the grower from that downward movement in the futures price. What would happen though if the futures market had rallied after buying that put option? So hypothetically, let's assume the grower had purchased the put option with a strike price of $3.50 and it cost him $30 to do that. But here we go, hypothetically the market has rallied since. Let's assume it's come up to this level now, so roughly $380 a tonne, hypothetically. This put value would have basically no value at all. The put option had no value at all. It may have a little bit of time value, but for the sake of this exercise, let's assume it has no value. But the grower is selling into a stronger market. So let's assume the grower is now selling at harvest time, selling for cash at, let's assume, $365 a tonne. So the grower has sold that grain at $365 a tonne, but the grower has made a loss of $30 on the put. So the combined final result for that grower is $335 a tonne. So what we have here is a really good example of a put strategy enabling growers to participate in any upward movement. Had the grower purchased or forward sold a grain at this point in time, or hedged, so sold a futures contract, or taken out a bank swap, the base of the grower is locked in at that price, regardless of what movements has happened subsequently. And in this example, the movement went up. So the grower could still participate using puts in that upward movement in that futures market. And that's one of the key selling points of using puts. So hopefully this has given you a good understanding of how put options work and why they are FlexiGrain's preferred strategy for managing the futures component in grain pricing in that pre-harvest window. Thank you.